It was a big week for markets with the Fed starting a rate cut cycle. I wanted to go through a bunch of things that I noticed last week. I just put this together so you guys can fast forward to where you want to go. But the first thing is just whether this was a mistake. I'm going to put it into historical context in terms of where the market is, where GDP is. Some areas that I think you can focus on to both watch as signals, but also, I think the ism now becomes important because the Fed did cut rates. China and Asia and what's happened so far this quarter, and some things to look for there. But then I think the most important news, and the one that to me is the most important for people to start doing their research on, is just the news that we got in AI agents. And then, I'm going to keep this year and going forward, everything expanding in terms of the intersection between AI and crypto becomes more important. And I think this was a big week for that, or a big month. And I'm doing, I've started a Substack. I did my first paper last week. The one for this week will be on the intersection of AI agents, crypto, and the fiscal deficit. So you'll get a chance to see that too, and you can that'll go out probably Wednesday. So just to go through these as quickly as I can, advance decline line. So breath made a new high this week, and most importantly, I just brought up this because I got a lot of questions on breath. Breath is one of the indicators that I've always used as an indication of a recession. It's not part of my recession models, but it is something that I use as a gauge for when I think things have reached a point where we're starting to see the economy break down. It never goes down in a synchronized manner early, so you have a lot of sectors breaking down. The thing I want you to highlight is how bad breath was in here, how really bad it was again in here in 23, and how you just can't even see any weakness here whatsoever. So when people talk about the concentration, the breath has been good all year. It hasn't been great, but it's been good. This is just the indication of back in '07. I had a full-blown recession signal in September of '07, before a good amount before the recession had started. And one of the primary reasons was because we had claims that were already starting to trend higher. We had a lot, S&P year over year was starting to break down, but also breath had peaked early and had already been in a decline for most of '07. And so I just bring that up because as you guys are going to go through this, you're going to realize what I think has happened is the Fed has cut 50 basis points into a stock market which is at all-time highs, an economy which has grown 3% year over year. The current quarter is looking at 3%, and there are zero indications in the claims market that people are losing jobs and unable to get them, despite what you're reading from people that want to be negative. So here is the S&P year over year, and I just put in the highlight how incredible it is that we cut rates with the S&P year over year up 30%. So if year over year S&P, which is a much better gauge than the ISM and a much better gauge than this, because the S&P changes over time. So if the economy becomes more service-based or it becomes more technology-driven, then what's going to represent it? An index that was created in the 1920s, or an index that constantly is redoing itself over time? So the S&P is up 30%, the Fed cut rates. To find anything close, if you look here, negative, close to zero, negative, all of these cuts were occurring when the S&P was either very, very low, had been declining in terms of year over year. The last time we saw anything like this was really in 95, 96. That gets important as we kind of move forward in these things. So I'm going to try to go through these. This is just another way of looking. We just cut rates with the S&P making all-time highs. There was a great thing by JP Morgan put out this week highlighting, and you can read this on your own, but 12 times when the S&P was in 1% of its all-time highs, the market was higher 1 year later, all 12 times. More importantly, since 1985 of the 10 best years for the S&P happened when the Fed was cutting rates without a recession. So for those of you, I believe, hoping there's a recession. If there's not, I would get out of your bear outfits very, very quickly and start to focus on what is happening. So jobless claims. I'm going to start, showing this again here. The reason jobless claims are so important from a recession signal. These are the quarterly increases in continuing claims. So again, continuing claims. People lose a job, they're collecting insurance, and it stays on there. They can't find work after they've lost work. You can see these are the recession periods. These are quarterly numbers. We're down so far this quarter, and over the last year, nothing. There is no recession going on. And for those people using the labor market as there, it's not happening. Claims is the best signal for the labor market, not the unemployment rate. GDP now. This is just what I said. GDP now looking at 3%, and again, just highlighting to you the how good it is in terms of at this stage relative to the actual reports, but more importantly, year over year is at 3.1%. Now, I just want to get into why I think so many people are negative and why there just hasn't been an adjustment, but there was one by someone who I respect tremendously. So this is the LEI. I've shown this chart before. We have never in the history of since the LEI was created, which was to help us with leading when a market is going into a recession, have we been at this level and not had a recession. This is why people are negative. This shows the coincident LEI. The blue line is the coincident. That means where GDP is right now. It uses current things. So think of the S&P. This is directly related to S&P earnings. So we've had something that hasn't happened before where we've got the LEI year over year moving lower and the coincidence not there. So Jim Bianco, who does good work, put out something this week, and he basically was doing a similar thing that I'm doing, which is saying models, especially in this day and age with AI, they're completely useless. And if you're using history and historical data, it's garbage in, garbage out, unless you're making adjustments to your model. The LEI is models, construction, and remember the thing, in many economists and market types. I could not agree more. Most people that I know still use the ism as a signal, but his point is it's not working. So I went to ChatGPT and I said, please give me the 10 components so that you guys can actually go through this. What do you notice when you look at this? So here are the 10 components that make up the LEI. Manufacturing. There's unemployment insurance. Manufacturing. ISM orders, new orders. Manufacturing. Manufacturing. Building permits. Those there, which make up the bulk of it. This one is very positive. This one is very positive. This one is very positive. You've got the old archaic yield curve, which hasn't worked because we've stopped lending to grow our economy, and we've had SVB and QE that have disrupted it. So when the curve gets inverted, you end up getting the situation you would think. SVB blows up and the Fed comes in there. You have to adapt. And this index has way too much in terms of the manufacturing side, and that's the big issue. So then I went back into ChatGPT and said, do you think this model is now outdated? Yes, the LA, due to this, service-based economy, software and AI, healthcare growth, traditional monetary policy, financial interventions, globalization. ChatGPT knows, but it seems like most economists have not made the adjustment yet, except for this one. I love Ed Hyman. He changed his tune and basically pivoted to a soft landing from a hard one. Ed uses all the same things that everyone. He's obviously above the age of that I talk about on the need for this, but he made the adjustment. And if you go through why he made the adjustment, he highlights a lot of the things that ChatGPT did. That's why this is so important. Is the Fed is cutting rates at a time when we don't have a recession. So I use that 95, 96. This is also 98. I highlight this. Basically, this is where the ism is. Now, I want you to do two things. We cut rates in here and we cut in here at times when we didn't have a recession. This is during the 98 emerging market crisis when I was in Brazil. You look at what happened after we cut rates in those scenarios that we didn't have it. We did have a low ism and then it rallied. So this is where I'm starting to go into some contrarian trades, and this came out of the Global Fund Manager survey from Bank of America this month. And I just want you to, you can see up here, but I want you to read down here. Contrarian trades overall are long commodities, China, resources. I highlighted this one, tech. Whenever tech is a contrarian trade during an AI revolution, I think you have to be worried about being bearish, because this has been a theme now. I've heard more and more people say that AI is done, that it's going to run out of power, all kinds of things that are just not true. And more importantly, even though I've said on this that I think the enthusiasm, meaning the euphoria, is gone, which I do believe, we're at the spreading phase of AI now into the enterprise software side, and I'll get into that. So back to the ism, and just as a contrarian trade, gold obviously got a lot of press this week going higher. I think that's going to be a theme. If you want the surprise, I think people should be more worried that the inflation side of things on the good side ticks up. That's what's been taking the headline CPI down, has been the good side. If we get any kind of pickup in China, in housing, in commodity prices, you're going to see a pickup because the core services sides are still high. This comes at a time when people are negative, not just from the fund manager survey, but the orange line here is the CFTC oil net oil position, which even with the bounce last week, we haven't seen it come through. You've had a small bounce in crude. People are not positioned for what could happen with an ism bounce, cutting rates. I think we should also start paying attention to the fact the election's happening. We've got tariff conversation going. That could lead to front loading of orders on people worried about the China-US situation. It happened the last time. That could get a bounce in ism as well. You're not looking for the ism to head back to 60. What you're looking for is where can we get a surprise that could lead to that? I've talked about my risk row index, which is a model I've built, which is meant to show the ISM real time. Here's the ISM down here, the orange line, and here's risk row. It was a big week for it. It bounced back up. We'll see if that actually goes through. Remember, this is based on asset prices and movements. So this includes stocks. It includes the Asian currencies. It includes the commodity prices, the CRB. So any bounce in this traditionally has led to a bounce here. It did happen on where this one led. We got a bounce in the ISM back above 50. I would watch this. Some other areas you can look for is beta versus profitability on the white side. Again, overlaid with the ISM. If you want to take beta versus profitability, you can look for the small cap trade to continue to outperform large cap on any bounce in the ISM if that does occur. I mentioned the Asian currencies. This is a huge move for the Asian dollar. It obviously was triggered by dollar yen, which is a big portion of this. But I just want to make sure people know the Asian dollar has been important, and I think Asia will be a growth region. I think they've got a lot of benefits happening from both the crypto side and the AI side that are happening. I'll take you through some of that. China is a really big negative that has kept down commodity prices. We'll still have to watch. They're still trying little things, but if there's any turn in the housing market there, that would absolutely get a bounce in the ISM for sure. So we'll have to see what happens with the election coming up in a lot of negative side. This is the long-term chart of the Asian dollar, the white index overlaid with the CRB raw industrials market. So we're getting a bounce here. We'll see if we get any bounce there. If that, I think you'll see at a minimum short covering in the ISM related space to show how big the moves are. These are the quarterly moves right now for the currencies in Asia. It's not just the yen, the Malaysian ringgit, Thai baht, Indonesian rupee, Philippine peso, Singapore dollar. These are strong, strong moves, which I've been looking for. I've talked about the Asian dollar for years as a very important signal. And just to put into context those quarterly moves, Japanese yen, largest quarterly move since coming out of the great financial crisis, since coming out of, this is another era, coming out of when oil had dropped down to $20 in the 15-16 period. Malaysian ringgit, the biggest, and again, here it is in 16. This is when the U.S. Shanghai Accord theoretically happened to put in the bottom in 16. I just think you're getting a big move in the currencies. You shouldn't ignore it. And here's a chart that I haven't been able to show for a while, but I love showing. This is the Straits Times Index. This is Singapore. I always think of it as the biggest port for China in terms of exports and imports. Whenever you see a big move in Singapore, historically, that has been the ISM. Obviously, I've talked about how the ISM has changed as an importance. You're getting more AI. Singapore is no different. So even though it is helped by the China-US side, you've got Singapore making new all-time highs, and this is overlaid again with the ISM. So important one. We had some US data, which gives reason to be hopeful on the ISM. This is the 6-month outlook in the Empire number, which came out this week. That's the white line. And this is the new order category, the orange line for the ISM. So we've had a bounce here in the Empire. It's just one data point. But when you combine the Empire and the Philly, which had a bounce last month, you get kind of a scenario that we could be having something. The housing market, remember, interest rates and where they've been have stalled the housing markets, the fast rise. Well, we just lowered 50 more. If we're going to build in more cuts this year, I think you have to start paying attention to the housing market. And remember, affordable housing and all these things, these become political issues. So finding ways to get people houses. This is the refi index, the white line. So the refi index has had a big jump on the expectations of rates coming down, and that's been driven by 30-year mortgage rates, which have continued to move lower. This is inverted, obviously. The stock market's already been discounting strength in the housing market. So I've shown this before. This is household durables relative to the S&P. They've done exceptionally well, but look when they really started to do well is when the rate cuts started. This is overlaid with housing sales. So we've had a housing market that has been stuck. This is existing home sales, which are near multi-decade lows. You've got a scenario right now where we'll see if we get any bounce. But at this point, the housing market I'd watch. There's a couple data points that have come out that I wanted to just show, just so people, I hear this a lot of times with what else has changed in the housing market. The overall debt situation in the housing market is just, the lowest since 1958. The percentage of houses that are fully paid for just continues to rise. These are important for why you can't get bearish on the economy the way you have in the past when interest rates go higher. ITB, which again is the ETF for housing related stuff, is right near the all-time highs, or no, it did make new all-time highs this week, and that's the importance relative to the S&P. This country has an engine of housing, has an engine of stocks. When housing and stocks are going up, it means consumer net worth is going up. When consumer net worth is going up, it doesn't matter what the savings rate and the income side is unless people are losing jobs, which claims don't. And that's why those categories are all part of my recession model. So you're just going through it. You just don't have it. I just wanted to jump to the one negative that has been there that you guys should pay attention to. If there's any change in this, this will be the big deal. This is China. This is their real estate year over year FAI. So fixed asset investment into real estate year over year. It's been sitting down here. I think the correlation to the CRB raw industrial market, so iron ore, copper, everything like that, that's what's been keeping this down. Is China had a big ramp up and then like the rest of the globe, and then it came down, and we're still in this place, and it's not changing as of now. So I don't want to get everyone hopeful that there's some sign. I can't see anything right now on China that makes it positive. This is it versus oil. So if China's not building and their housing market is not in great shape, it's really hard to get a sustainable bounce. But I do think a bounce is more about short covering and more about maybe some growth going in other parts of the world. And like I said, the getting in front of the tariffs. Here is the PMI, and this is now overlaid, or this is the month-to-month change in prices in China, house prices. So we just had the worst move since we go back into this 14-15 period. The reason I bring this up, basically China's going through what the US went through in 07 and 08. The difference is they're printing money to offset it, so you're not getting a collapse. But I just want to show any change in the house sales or anything, that will be a leading indicator. I'll highlight it when I get any data points. But I think that's where the surprise is you can play on the ism side at this point and watch it as a signal, and Asia should be the driver. This was the most important news, and I think everyone should be doing some rabbit hole research and spending a lot of time on how important AI agents are. This is from May of 24, and I'm just highlighting this. Basically, think of them as apps, and I'll get into the reason why. You get handed a phone, your iPhone back in 2007. It doesn't really become useful in a major way until you've got the apps that are doing things for you. That's when you start to get the expansion of the ecosystem. Here is, and I would pause it here, and I would read every single one of these. These are the important people out there about talking about how important AI agents are, giving you the definition of what they are. It's a critical part of what I've been waiting for. When ChatGPT originally came out, I spent time on AutoGPT to get a sense as to how this could be the do-it-yourself side of things as opposed to having it go through. That's where we're at, and the reason I bring that up is the All-In podcast group had the All-In Summit. If you get a chance, I would listen to 3 interviews. Elon Musk, Sergey Brin, who gave his first interview since back at Google, and then also Mark Benioff. And this is what Benioff basically talked about. They had their Dreamforce event. You have to go listen to it because this is really acceleration of AI into enterprise software. And what he said was, let me just make sure you can see it. So AI agent means no DIY for clients. As someone who worked at a fund that tried to incorporate AI, AI is the do-it-yourself side at this point. So bringing in agents, which will allow the agents to do the work, is really critical. And so I think you just have to kind of think about what it means with all this. This is all news that came out this week. Again, it's not just Salesforce that's saying this. He specifically mentioned Disney as a company that is one of their clients that'll be using it, but they have thousands of clients where people already have the software, and now we're talking about having AI agents in the ability for companies to use it. So other companies came out immediately. You see this almost always in AI. OpenAI does this all the time. Everyone's in a race. So once one person announces it, you get a lot more. I put the Sergey Brin thing here because, again, the interview, which I think is only 25 minutes, was really important on my side. There were a couple things. For those people that are negative about the power situation, he made this very, very simple thing of it reminds me of the leading economic indicators, but the way people have been negative on AI is saying we'll run out of power if you extrapolate the compute. And he basically said because of the algorithmic improvements that have come over the last few years, we're actually even outpacing the increased compute. This is something that's really important as you guys go through this. There's a lot of news this week, which I'll continue to go through right now, on the power situation in terms of the 3 Mile Island. But this is a situation where we're starting to get the spreading. So I just wanted to highlight this because you've got Intel, something happened with Intel with AI. Then you've got the CEG situation and the 3 Mile Island. Then you've got the Salesforce announcement. You also have Oracle having a bump. And just look at what their stock prices did. So this is the weekly move for Oracle, one of its largest moves in the last few years. Intel obviously had a big week, and then you've got CEG. It's starting to spread, and yes, this is a large cap over small cap benefit for the same reason that when you listen to Mark Benioff, it really is an advantage if you're already paying for this more expensive software and you have it, and these companies that are spending all the spend on getting AI uploaded into their own software, you're starting to get it. And I just want to end this. I had on there the importance for crypto, and it will be a focus of the Substack paper. But I just want to bring you back to the end of last year. Brian Armstrong, who's one of the people I like to listen to in crypto, he basically said this, which is really important. When you're looking to see how crypto represents AI, which I believe it does, it's the reason I think if you want to invest in something that goes faster and is more stable than AI, than the mega cap tech names, I did that whole Bitcoin paper showing that they've outperformed, and that's because Bitcoin to me is the S&P 500 of the new world, the new economy we're headed toward, run by crypto. And for that, AI is the critical thing to get the bridge over. And he basically said that the intersection, or the worlds colliding, will intersect through AI agents. So the fact that we've got these going on in the software world is important. And that was back in December of 23. Here's what Brian Armstrong said finally in September. First A to I crypto payments now underway. This is going to lead to a lot more digital transactions. It comes at a time when robo-taxis are starting to take off, not just in the US, but across the globe. And with all of this, you're going to have more and more crypto payments, which will be done through stable coins. But this is how you get the ecosystem of this economy going faster. So I'll talk more about that in the Substack. That's it for me on this. It was a big week, in my opinion, for markets, and I wanted to share my thoughts. Thanks.